So good morning. Thank you all for joining on this Saturday morning. So the topic for today is how to chase your investment goals through mutual funds, the IPL way. So it's just like how when you bat second in a cricket match, you have to chase the target. So the end target for the cricket match, for the cricket team who's batting second will be the same like how you as an investor who want to set a target for your investment goal. Like, so both of these things are as usually the same actually. So the main reason why I chose this topic was the obvious reason is like the IPL season is on midway, and also I happened to go through a interesting article on Mint, which is this is the article I was speaking about. So like here like in this article it generally states that like uh, there is one particular number that every investor generally most of the investors doesn't go through or doesn't set. So generally think of it like if a team comes to bat for second and they don't know what's the target, so then the match would be irrelevant, right? Just like that, if you don't set a specific uh, return rate, like generally it's like you're not investing in a very in a correct or a process driven way. So like when a cricket team tries to chase down the target, generally they'll try to achieve a particular run rate for every over they want to do, and by keeping in line with the run rate they can generally easily chase the target. So just like that, you need to target a rate of return every year, and if you compound at that rate you can comfortably achieve your investment goal you want to achieve in a certain time period. So this is what it's all about. So what is RRR? RRR. So RRR is required rate of return. That is the minimum rate of return you need to get in order to achieve your investment goal. So generally, people who don't have a specific rate of return, like they don't know what they'll achieve, and generally it's not the right thing to do. So now let's look at like how to create a investment portfolio, just like how a cricket team, just like how a balanced cricket team is formed. So basically, like you have to have a diversified and a balanced approach, be it a cricket team or uh, be it an investment portfolio. So you need to cover like all market segments and all asset classes. So just think of it like generally a batsman like score runs, and uh, bowlers try to defend or contain generally. So basically your equity would be your like the asset class which would drive the returns, which would create wealth for you in a long period of time. And debt is used when the wealth you created, you mean you when the wealth you've created, like you need to protect it, right, to sustain. So at that point of time you need to use debt. So you just need to think of it like this. So generally the opening batsman needs to be very consistent. So like the large cap can be used as a consistent driver in the portfolio, and like the people who come in the middle order are generally like the power hitters. So here you can use the flexi cap, mid cap, and small cap in your portfolio. And like the all rounders can be your multi asset funds, your hybrid funds, or taking exposure to gold, silver at the right point of time can also use like this. And the main thing is like generally you don't need to depend on one player. So think of it like generally like most of the losing matches, the team would have depended on only one player. There's a lot of instances And even now, like generally, our favorite team, CSK, is kind of depending on one player. Like, but it has to change, right? So definitely, you need to diversify and build a concentrated, good balanced team in order to win. So here, let's just look at like how SIP and rotating strikes, that is playing single on each and every ball, how it contributes to your overall improvement of your portfolio. So like generally, to maintain a good run rate, you need to score a lot of singles, ones and twos, right? So that's just like that. You need to keep on continuing your SIP so that, like, at least even if there is no opportunity, or even if you're not doing big amount, like monthly basis, you're somewhat able to scale up the portfolio. And when you do it for at least like 3 to 5 years, even that amount becomes a sizable corpus. So, like, doing SAP is better than not doing anything at all, or just sitting in the sideways and waiting for a market correction. So this is like just like when like just take Virat Kohli as an example. Like he's called as the best chaser. Like whenever like India like has chased successfully, Virat Kohli has been a prime contributor in most of the matches. And the main thing he does is, like, generally he plays a lot of singles and doubles. And when a bowler bowls a loose ball, he'll definitely convert it into a boundary. So just like that, like you can just do SAP when like you couldn't find clarity or you couldn't find opportunity, and whenever there is like market downfall rate, when correction days, even if the market corrects by like let's say 3 or 4%, you can do like small lump sums, which can also contribute to your investment return, because days like what you do on days like this actually matters the most. So like so now you can connect it, right? So a combination of SAP and lump sum is what works the best in the long run. And that is why in Milestones to Wealth also, like we generally advise you to do both. Like whatever you're comfortably able to save, like you can do that as an SAP. And like there will be some correction days on some months, and at those times we'll also give you a communication to do a lump sum. At that point of time you can do lump sum. So like a combination of both SAP and lump sum is the best. So now let's look at what common mistakes are there, both in like when we're doing the investments and while playing a match. So generally, like when you want to chase a big target, like the team who comes to bat in the second, like because of the pressure, like they try to play big shots very early, and like they don't take time to settle or anything, so they lose a lot of wickets very early in the innings, which which makes difficult for the team to chase the target. Just like that, when you start your investment journey, like taking too much risk in your portfolio by investing in small mid or like trading will actually impact you. So which will make the damages even more higher. So the time taken by you to get up and even to break even would be very difficult, which will make your investing journey a very displeasant one, and which will like you don't want to continue investing, or you want to stop investing. You'll feel just an FD would be better. So that is why in the starting of your investment stage, like it's better to like play it very carefully and slowly. And once you reach a particular level, then like you can even with the profits you make, like you can rotate it into the riskier bets, or you can take outsized bets on the profit you make. So another thing is mainly like you need to beat an investment or cricket, you need to do a thorough analysis, like a market research, be it reading the pitch. Each and every stadium would generally have average score, and that is the score generally like the team can put on the board. Just like that, generally the markets also have a certain rate of return in which like it has delivered in the last 2 or 3 decades. So you need to align with it, and your goal needs to be outperforming that, but you shouldn't target very high returns so that you take even more risk just to achieve that. So, like being an aggressive investor doesn't mean that you want more returns. It's basically like identifying opportunity, a correct opportunity, having a high conviction on that, and taking outsized bet on it. It's simple as that. Last year, it doesn't mean that if you only invested in small cap, it means you're an aggressive investor. Last year, there was good opportunity on the gold side. The market corrected around 10-12% on when the government cut the import duty for gold and silver. At that time, if you invested heavily in gold, it means you're an aggressive investor because you saw an opportunity on that. So being an aggressive investor doesn't mean you should stick only to a certain certain asset category. You can you can have conviction on a particular thing, and you can take an outsized bet. It's simple as that, actually. So basically you need to do thorough research, and you need to play accordingly. So that's about it. So patience, as you know, yes, uh, mostly the topic is like chasing, but still you need to have patience even to chase. Yes, it mainly depends on what kind of investor you are, what kind of game you want to play, be it whether you want to play a T20 kind of an innings, or you want to play a one day, or you want to play or you want to play a test level cricket. So you just need to decide on that, because at the end of the day, investing is a very long term game, and once you build that base, the rest of the thing, the correct investments, if you've done it and you've built the base, the balance compounding actually takes care of the remaining part. So it's better to have a very very long term approach. And yes, investing, as the masters say, generally investing is kind of a test cricket, but still it's better to have some decent required rate of return in which you actually want to target, in which you need to compound. And also generally, you don't need to take very impulsive decision based on some few blips you get, so that generally most of the times it will result in a very disaster. So just in a just like a strategic timeout, you actually need to review your portfolio at regular intervals, and you just need to see if the conditions has changed. So one thing where is even you take in the last 5 years, so markets, the COVID bottom happened, and generally a lot of investors got panicked. A few people who had conviction invested, and again one more time around 2022, markets got corrections happened because of the Ukraine and Russia war. And after that, 2023 onwards, a very uh, a superb bull market started, and it almost lasted till last year, 2024, September 2024. And from that, the market has almost changed. Yes, even now, the markets are going up, but it's very volatile, and a definite direction is not ascertained, right? So the best thing would be to review your portfolio because one cycle has almost been completed. So now you need to check what investment changes you can, bring onto your portfolio. Like you can realize good profits if you have some good returns you made in some stocks, and you can convert it into debt. And last year what we did was, like, we made good returns for the investors, and we want to sustain it. So actually what we did was we took exposure in gold. So the main reason we invested in gold was we didn't know we would get very high returns in gold. We want to protect the returns because the downside would be very low in gold, as you all know. So that was the main reason. And now, like for the long-term clients, that is the client who have invested in gold more than 2 years, like we are booking profits and we are changing it into debt and into consumption. So this is how we review and rebalance the portfolio on a timely manner. So now I'll just we can just I'll just summarize what we discussed. So basically, you need to be consistent in your investment and in your chasing when you're chasing the target. So even if you couldn't find opportunities, like you can just use your savings and use it as a sip, so that like you can average the price down the line. And also like it's it uh it gives small contribution to your portfolio. And you need to do a thorough analysis on a timely manner, so that you stay updated on what's happening and you make the necessary changes which is required according to the market condition. And based on this, you need to change whatever changes are needed. And generally, it's better to have a balanced team, so that whatever happens, if some players couldn't contribute, other players contribute. Like meaning, this year, uh, we almost equity didn't perform well, but still gold, silver, gold mining, banking to some extent gave returns, right? So it's just like that. So you don't need to depend on one player to achieve all the return. You need to have a balanced approach, so that if some players lag, the other people's contribute to your overall win of your portfolio or your team. And the main thing is you need to adapt to the situation as the situation changes, and you need to bring the necessary changes required in your portfolio. And capitalizing on loose balls. So as I was saying, when a bowler bowls a loose ball, the player goes for the big shot, and just like that, you need to do the market research, and you want to target a few ideas you want to buy at a cheaper price. And just like that, when rainy days come in the market, you need to act on it, and you need to do a large sum amount, a lump sum amount, and you need to make the investment. And main thing is you need to be patient, and you need to stay calm when pressure situation arises. So basically you don't need to make impulsive decisions on those days. And strategic times, yeah, so it's like periodically reviewing your portfolio. And the main thing is learning from past mistakes. So past mistakes in the sense you would have made you would have have had good conviction on few ideas, but still some other people on the general overall market generally won't like that idea, or they would have a different perception, and those judgment would actually cloud your judgments. And and another example is the recency bias. Just because when markets corrected, they generally went up in the last 4 5 years, because markets didn't even expect a minus the market didn't even get a minus 10% correction in the last almost till 2024. After 2024 only a minus 10% correction happened. So generally people on the last 4 years a correction didn't happen and the markets were always going up. So that's recency bias. So since the correction didn't happen at all, people thought even after that September small correction, the markets would go up, but unfortunately it didn't. So that's why you always need to stick to valuations correctly, and when the valuations are very high, you need to realize your profits.